And I haven't had enough opportunity to thank her for the wonderful bank that I inherited from her. Because while she's right that in 2007 we had the start of the financial crisis, and she's probably the best market timer I've ever seen, knowing exactly when to leave. Because the bank had been run so wonderfully, there really was an opportunity to worry about all the things that were happening in financial markets and trying to think through the very unusual period we've been in the last 5 years. And it's really through the strength that Kathy brought to the management of the bank, making sure that there was a really strong research department, really strong bank supervision department, and all the other areas of the bank. And if we have problems in the cash vault, I would have been spending my first year worrying about what happened to the cash in the cash vault. So it's really important to make sure that you have a bank that's running well. Kathy really did that, and so it gave me the flexibility when we did have a crisis to turn my full attention to that. So thank you, Kathy, for giving me a I really enjoy this forum. It's really nice to have a very diverse crowd. I sometimes talk to crowds that are bankers. I sometimes talk to crowds that are students. I sometimes talk to other groups, but very rarely do I get the kind of mix that we get in this room. And it's really a credit to Barry and Mike and Kathy, who had the wisdom to start this entire program. And so hopefully, I'm going to go through some slides. I'm an economist, I like data. So we'll go through all that, but hopefully it's also an opportunity for people to ask questions. As Kathy's highlighted, it's been some controversial periods. It's been a very unusual period. I completely agree with her assessment that we're very fortunate that Ben Bernanke was willing to come in during the crisis period and stay on through a period that has been very unusual. And it's not just the central bank in the United States. We've been fortunate that there have been some pretty good leaders worldwide. Because this chart is very unusual by United States standards, but if you look at the Bank of England's balance sheet, it looks like this. I'm going to show you a slide of the Bank of Japan that looks like this, and increasingly the ECB looks like this. So it really is a worldwide phenomenon. I think it's important for people to understand why we've taken the actions that we have, what the implications of that are. So let me start by what my title is. So my title is Acting to Avoid a Great Stagnation. So what do I mean by a great stagnation? So if you look at historians and you look at economists, they're very different disciplines. Historians and economists both look at historical data. They try to understand what's happened in the past and try to process that to make the future better. When a historian uses a word like great, think of Alexander the Great, Peter the Great, Catherine the Great. Great means great. Somebody who did a really good job for their country. Usually it's a military victories that expanded the territory. So it's pretty understandable what great means. When an economist uses the word great, think of Great Depression, Great Recession. It means not so great. And so it is a little bit of an irony that economists are once again thinking of the word great in this period. And I think what's critically important is to make sure that this period is not characterized as a great anything. And the focus, I think, really needs to be on why we've taken such forceful action in order to make sure that this doesn't become a great anything. And really my talk is how we make sure that when history looks back on this period, it doesn't have an economist title of great. So what would make a great stagnation? Well, one way you could have a great stagnation is for policymakers to accept the fact that we have unemployment rate at 8.1%. It's basically the same place that it was at the beginning of the year, and decide that they weren't going to take any action, that it was acceptable to have unemployment rates this high, despite the fact that inflation was 1.3% by the measure that the Federal Reserve focuses on. So we have an inflation target of 2%, an unemployment rate of 8.1%, but there are many voices, both inside the Fed and outside the Fed, that are arguing that we really shouldn't be taking significant action. And they're right that many of the things that we're doing have costs associated with them. But one of the biggest costs to me is making this unemployment rate a permanent feature of the economy. And I'm going to show you some slides on Japan. Kathy gave a perfect introduction for my comments on Japan. Europe also went through a period of very, very high unemployment for an extended period of time. And so what we want to make sure we don't have is an acceptance of very high unemployment rates because there's labor market scarring. What do economists mean when they talk about labor market scarring? It's the idea that if you've been unemployed for an extended period of time, it's really hard to be reintroduced into the job market. So the longer that we have a period where people have very long duration unemployment, the harder it is to make sure that those people get reintegrated. So there's a real cost of not doing anything, just like there is a cost to taking unconventional policies. So what has the Fed done? I'm going to come back to this, but let me just give you a preview. I wouldn't view the actions that we took a week ago as an indication that we think the economy's getting weaker. I would instead take it as an indicator that we want it to grow faster. We want stronger growth than we've been seeing. So I'm going to have a figure later on where you'll see the GDP growth. You've been roughly growing at 2% since the beginning of the recovery. And you'll see a chart that shows that it's better than many of our trading partners. But 2% is not good enough to get the unemployed to be reemployed. So it's not that we're not getting positive growth, we are. But it's just not getting the kind of growth that we need to get a full recovery. So we've announced that we were going to do asset purchases, and the focus was on mortgage-backed securities, and I'll talk a little bit more about the reason for that. We're still buying long-term treasuries, and Kathy explained it exactly right. We can't move the short-term rate, so we have to flatten the yield curve. And so basically these other actions, we're buying securities, it's just a different set of securities. Normally we buy short-term securities, now we're buying long-term securities. Normally we affect the short-term interest rate, and through that affect the long-term interest rate. Now we're much more directly affecting the long-term interest rate. That's an unusual policy, and I'll go into more detail about that at the end of the talk. The second feature is the open-ended feature. And I think this was a really important part of the announcement, which was saying that we're going to keep doing things until we get the right economic outcome. That's very different than what we've done before. We've said we'll keep purchasing things until we get a certain amount purchased, or we'll be doing it until a certain date is reached. This is saying, no, the whole purpose of this purchase program is to say that if the economy gets worse, we're going to do more. If the economy gets better, we're going to do less. We're going to focus on getting the kind of economic outcomes that are consistent with our mandate to get full employment consistent with stable prices. So I want to hit that last line a little bit more, the context of price stability. There are periods that it's really important for us to be focused on inflation. Again, Kathy gave a perfect introduction to that. When Paul Volcker came in, we really did have to focus on inflation. But right now is not the time that we really have to focus on inflation. There are concerns, and I don't want to underweight the concerns about inflation or inflationary expectations. But Kathy's balance sheet expanded in the fall of 2008. 4 years later, the great inflation that people were warning about hasn't occurred. And I'll talk a little bit about the reasons for why it hasn't occurred. But 4 years later, and when we think about the balance sheet, it's really the size of the balance sheet that should matter, not how much we're purchasing. So if you get an inflation at 1.3% after that chart that Kathy put up, it highlights that you probably don't want to be focused on inflation right now. You want to probably be focused on the other part that we're not hitting so well, and that's the unemployment rate. So it is unconventional policy, and there are risks with any unconventional policy. First of all, usually economists spend a lot of time studying, gee, if we do this, what happens? And when we move the short-term interest rate, which is called the federal funds rate, we have a whole lot of history in the post-war period that if we raise or lower those interest rates, what's more than likely going to happen? So that there's a certain consistency and a certain understanding that if we raise the short-term interest rates by 25 basis points, we're probably going to slow down the economy, there's going to be effects on unemployment. This is what we expect with inflation. When we're purchasing things we've never purchased before, we don't have any history to actually gauge exactly what the effect will be. So there's much more uncertainty to what we're doing than there is normally. And so that is a concern. And Kathy showed a very expanded balance sheet. At some point, we want to be able to exit that balance sheet. The Bank of Japan had a very expanded balance sheet. They never exited. And I'll show you that chart. But the Bank of England hasn't exited, we haven't exited, the ECB hasn't exited, so we have no experience with actually exiting these big balance sheets. So people that are concerned about the exit strategy have a very legitimate concern. But just because it's new, just because we haven't done it, just because we don't have a lot of empirical experience with it, doesn't mean that if it's necessary, we shouldn't do it. And that's going to be the argument that I'm going to talk about why it's so necessary. So I'm going to use the real-world example of stagnation as Japan. And as I mentioned, both Japan and Europe have had periods where they've had a lot of unutilized resources for an extended period of time. Focus on Japan because I have more expertise in that area. And I think it also serves as a nice analog because it was really tied to a financial crisis in a way that some of the European problems weren't. Now, there are many differences between Japan and the United States. The demographics are very different. They are at the point where they're close to a shrinking population. Their population has aged much more than our population. That has implications for what kind of growth rate you'd expect from that country. They don't have the immigration policies that we have, so it really does mean that more than likely they will be facing a shrinking population. And they did have a very serious banking problem that they didn't address. So there are many criticisms of how we handled the banking problems in the fall of 2008. But the Japanese really took it to an extreme. And as a result, their banking problems were perpetuated for a very long period of time. So this isn't a perfect analogy, but I think it does highlight what we don't want to become. So this is a picture of Japan's real gross domestic product. Their financial crisis occurred in 1990. And as you can see, they were growing along a trend line. The financial crisis hit, stock price declined and hasn't really ever come back. Commercial real estate or residential real estate prices declined and never really came back. They've had, I'll show you a chart in a minute that's looking at their inflation, but they've had a deflation problem, not an inflation problem. And you can see that real GDP, that slope of the line changed. So if you think about the difference between that dotted line and that green line, and kind of look at the end point and see trillions of yen, the amount of loss to have that slope of that flatten out is really a horrific cost to the Japanese people. Now, it's not all just because of what happened with the financial crisis, but it is noticeable that it occurred right at the time that the financial crisis occurred. If you thought it was primarily demographics, you wouldn't expect it to be a straight line that was kinked at 1990. So this is what we want to avoid. We don't want to have a period, if people talk about the lost decade, you can see that line's been flat for a lot longer than 10 years. It's really a misnomer to talk about the last decade. It's basically almost lost last 25 years. So it really is quite striking. This is the United States, same chart, same period. So a couple things to notice. I have recession shading there, so each of the recessions are shown. You can see during periods of recession, we tend to fall below the trend line. But then in the recovery, we come back pretty quickly. So the normal recession will last for 9 months, 12 months, but the recovery quickly brings us back up to the dotted line, and we continue along that path. Sometimes we do it more quickly than others. But I think it's important to look at where we've been during the Great Recession. The first thing to notice is how wide that line is. It was really wide. It was also a very big change, so it's a much bigger shift in that line. The 1982 recession was actually a fairly severe recession, but there was a very quick recovery, so it came back quickly. What's noticeable about this is we haven't really come back to the trend line. So if that were to continue, which would be equivalent to GDP continuing to grow at 2% roughly, which is we're having positive growth. We are adding jobs, we're just not adding jobs fast enough to get back to that dotted line. It's much better than the Japanese situation, so the line didn't get flatter. But it does mean that we're losing all that output for as long as we stay away from that dotted line. Well, over time, that gets to be very, very costly. So that's also something that we want to try to avoid. So it's not unusual after a financial crisis to have a fairly slow recovery. There are lots of reasons to explain why this recovery has been slow, and I probably don't have enough time at this forum to go through all the reasons for why the economy's grown slowly, but we certainly have time during the question period that I can expand on this thing. So I'm going to just focus on three that I think are critically important. The first one is looking at housing and government spending. So what this line does is it looks at real GDP, the actual growth rate that we've had, which has been 2.2% during the recovery period, and look at it taking out residential investment, which is housing, and government spending. Now, normally, residential investment is the leader for getting us out of a recession. Why is that? Well, normally we see the unemployment rate go up, the Federal Reserve lowers interest rates, we start hiring more people, residential investment starts growing very quickly because people start getting jobs, interest rates very low, wonderful opportunity to lock into a house. This time that didn't happen. In fact, in the slide I'm about to show you, housing has stayed down. A second element is that government spending has been very different. So many people have focused on federal spending, but state and local spending is roughly 12% of GDP. Many of the towns that you all live in, you've been laying off firemen and policemen and teachers. That is a reduction in government spending. It's just the state and local spending. State and local governments don't have the same flexibility that the federal government has. They ran through their rainy day funds relatively quickly. The recession was deeper than they expected and longer than they expected. And the result is, since they can't run deficits, that they've had to cut government spending fairly appreciably. So if those two elements had grown just as fast as the other components, we'd go from 2.2 to 2.45. Well, even 0.2% over a few years starts adding up in terms of bringing the unemployment rate down. And normally these two sectors don't grow at the same rate as the other components. They actually tend to grow much, much faster than the other components. So this really understates the amount that we could have gotten if those sectors had operated more like we normally see. So this is a picture of housing starts. So a couple things to note. One is how substantial the decline in housing starts has been. It's understandable, the housing sector did very well prior to going into this. Everybody knows that we've gone through a boom and bust period. But it really has been very, very substantial how much housing starts has come down. On a positive note, I would note that over the last couple of quarters, this has been trending up. So that's one of the reasons for the Fed to think a little bit about, gee, if I was going to try to get something to start going again, what should I focus on? Housing's already starting to pick up. For those of you in the audience who may be thinking about purchasing sometime in the next couple of years, well, if you start seeing housing prices go up, there starts to be a cost of waiting. And if the Federal Reserve pushes the rates real low, but you know that we're not going to do that forever, well, now you're faced with very low costs, prices going up, probably a pretty good time to buy. So one reason for us to focus on mortgage markets is to try to get one of the areas that's been particularly slow, now that we're starting to get a little bit of traction, to get some more movement. So over the last 5 years, the population in the United States has been growing. Income's been growing, though very slowly. And so the hope is that if we can hit the housing sector a little bit more strongly, we might get a little bit more of a self-sustaining recovery than what we've had to date. The second area is state and local government spending. The kind of decline that you see here is really fairly unprecedented. So I'm not a specialist in state and local government spending. There are people here that are probably much more conversant than myself on some of those patterns, but it really has been a very, very substantial decline. Normally, it actually is a source of positive growth, not the kind of decline that we've actually seen. The third thing is what's been happening globally. So we have a global slowdown. Everybody's aware that there are problems going on in Europe. What this looks at is the change in real GDP from the end of 2007 to now. So if you get to 100%, it just means your GDP is where it was back in 2007. So what's striking is how many countries aren't even back to where they were at the end of 2007. When you think of the problems that we had in 2007 and 2008, and the fact that in the US we kind of generated many of those problems, it's really striking when you look at countries like Japan and France and the United Kingdom to think that they're still below 100%. So they haven't gotten back to where they were in 2007. And actually, some of them are starting to have their line move away from 100%. which means they're going back into recession because of some of the problems that are going on in Europe. That's a really distressing trend. Now, if you look at the United States, you can see that is kind of the bluish-purplish line. It's continued to grow, and we're actually doing better than many of our trading partners. But the fact that the rest of the world is growing very slowly has implications, particularly for a place like New England, where we export to Europe. Having a number of those countries that are starting to go back into a declining growth rate is really bad news if you're a manufacturer in New England who wants to export to Europe. So those three factors, not by themselves, but play a very important role in why we've seen such a slow recovery this time. So there are significant costs to having a very slow recovery. And so I want to talk a little bit more about the labor markets, because people talk about what the costs of the Federal Reserve taking action, but sometimes don't spend as much time talking about the costs of the Federal Reserve inaction. And a lot of that inaction is felt by people that are either underemployed or unemployed for extended periods of time. The last thing we want to have is temporary labor market problems becoming a permanent feature of the American landscape. The fact that we've had such a slow recovery already risks that that could potentially be true. Economists argue about how much unemployment is cyclical and how much of it's structural. Part of that depends on how quickly we recover. A very, very slow recovery may turn some of that, what we thought was a demand problem, into a problem that people can no longer get back into the labor market. So this is the employment to population ratio. So it's just looking at the percentage of the population working. And what you can see is this really was a great recession. A dramatic decline in the employment to population ratio. But even more striking is the recovery. In terms of employment to population ratio, there hasn't been much of a recovery at all. It's very unusual for that to be basically a flat line. But that's very consistent with the GDP graph that I showed you, where the GDP was growing at 2.2%. Because when GDP is only growing at 2.2%, it means you're not reemploying those people that lost their jobs during the recession. And so this is really highlighting the fact that there's really been no progress in labor markets during this entire recovery period. Perhaps the most distressing chart that I have in this set of charts is the long-term unemployed. This is really uncharacteristic of US recoveries. Normally, we expect, you can think of some of the previous recessions that we've had, they're layoffs, but they're viewed as temporary layoffs. As the economy picks up, people are expected to be reemployed. That's true if you're an auto worker, that's true if you're in the construction trades, that's true in many areas. Now there's always some shifting of industries, and not everybody gets back into the same industry they were in before. But to have people that are unemployed for 27 weeks or more, to be 40% of the people that are currently unemployed is really a striking statistic. And if you look through the historical period, normally when we have a deep recession, we tend to have a fast recovery. If you have fast recovery, you don't have people with very long duration periods of unemployment. The fact that we had both a very deep recession and a very slow recovery, it's kind of not surprising that we have a lot of people that have been out of work for a long period of time. But one reason for wanting to get the economy to grow faster than it's been growing, even though it's been positive growth, is to try to bring this back down so that people don't continue to be unemployed for extended periods of time. So what can policymakers do? I'm not going to be talking about fiscal policy tonight. It sounds like there are plenty of programs that will talk about fiscal policy coming on. But what can monetary policy do? Well, we're at the zero bound. So that does force us, short-term rates can't go any lower, can't go below zero. So we have to be thinking of things that we haven't thought about doing before. And so when we think about that, there are definitely costs. As I mentioned before, the impact is less certain. But I really want to emphasize that it still may be quite reasonable to do something. So this goes back to Japan. So we've talked about unconventional policies, and Kathy showed the picture of the United States, and I'm about to do the same thing. It's a really good chart, so I included it too. But if you look at Kathy's chart and you look at the Bank of Japan, there are some important differences. So one of the striking features of Kathy's chart was the fall of 2008. very abrupt, very substantial, and continue to be pretty substantial. So you can see that the Japanese, when they hit interest rates for the short-term rate at 0, they started buying other assets. But they did it very, very gradually. So they didn't really provide a shock to the market to try to get things going. It's kind of they grudgingly decided they ought to do more. When they decided to grudgingly do more, it was not only the size of the balance sheet, but it's what they decided to buy. They decided to buy mostly short-term treasuries, equivalent to our short-term treasury securities. So if I have currency that pays next to nothing, or nothing, and I have a short-term security that pays next to nothing, I'm not going to get a big impact just having people hold treasury bills that pay virtually nothing instead of currency that pay nothing. But that was their strategy. They thought that by just creating a lot of assets, they might start getting a little bit more inflation. So how did that work for them? Well, let's look at the Consumer Price Index for Japan. You can see that the Consumer Price Index has been below 0 for quite a period over the last 20 years. And it's particularly noticeable that they're still fighting a deflation problem, even though their crisis occurred in 1990. So when people talk about what about inflation, the one example that we have where a central bank has expanded their balance sheet, they did it in such a way that actually they have a serious problem with continuing deflation, not inflation. Now, it's not impossible that a big balance sheet will cause inflation. If you start getting the economy going again and it starts becoming self-sustaining and the central bank doesn't do anything about that, then you could get inflation. But it would take a pretty big policy mistake because we'd observe inflation, we'd observe that banks were doing more lending, we'd observe that people were becoming employed and the unemployment rate had come down. So if we're asleep at the wheel, we can certainly get an inflationary problem. But I certainly don't expect Ben Bernanke or anyone else at the central bank to be particularly asleep during this period. And actually, right now, that's the least of our problems. We really not need to focus on inflation to the same degree that we did during the Volcker period, because that's not the problem that we're currently facing. So just to graphically show the same chart that Kathy had, but with a little bit broader time period, and just emphasizes how dramatic that change was in the fall of 2008. So you can see that it's very abrupt, it's continued to grow, and because of our actions a week ago, it's going to continue to grow from this spot. The bottom chart provides the personal consumption expenditure price index. That's just a price index that the Fed tends to focus on. Our target's 2%. You can see that right now we're below that 2%. If you look at the core rate, we're taking out food and energy, it's 1.6. If you look at the total measure, it's 1.3. 1.3 and 1.6 are both below 2, so we're below the target. That gives us some flexibility to focus even more on labor markets than we otherwise would want to do. So people that are talking about this is going to be very inflationary, anybody who's an economist who tries to run a regression that takes size of the balance sheet and puts inflation on the other side, is going to have a really tough time teasing out a big inflation problem. Because we've had a huge expansion of our balance sheet, and we've had virtually no inflation, and the same thing's been true in Japan. Actually, in England, the inflation rate, while it's above 2%, has been coming down. In virtually every country that has expanded their balance sheet, they're expanding it because we're not getting enough inflation in some respects. We're not getting the labor markets to heal quickly enough. So let me talk a little bit more about the Fomc announcement. So it was actually, while we're trying to be much more transparent and clear, I have to admit the first time I saw this statement, I had to read it several times to try to figure out exactly what it was that we were trying to say in this. So I'll try to do my best job at translating central bank. What we're trying to do is be transparent, but our words are somewhat mystical even though we're trying not to be. So first of all, we're buying $40 billion of mortgage-backed securities. That is a fairly substantial amount. So, and it's a commitment to continue to buy them. It's not a fixed amount, it's not a fixed date. We're going to continue to buy $40 billion a month. The second part is that we're buying long-term Treasury securities. So we announced in June that we were going to do a thing called Operation Twist, or at least that's what it's frequently called, which was that we were going to sell short-term securities and buy long-term securities. Well, why would you do that? What you're trying to do is bring down that long-term rate. You're trying to flatten the yield curve. So both of those actions are trying to bring long-term interest rates down. Now, it's not just the long-term interest rates in terms of mortgage-backed securities, and we actually don't really care about Treasury securities in and of themselves. What we're trying to do is get long rates down for anybody who wants to borrow at the long end of the market. So if you want to get an auto loan and you want to get a 5-year auto loan, the fact that we're flattening the yield curve should make that auto loan much cheaper. If you want to buy a house, you want to get a 15-year or 30-year fixed mortgage, the fact that we're flattening the yield curve can have a substantial impact on what the cost over the life of that mortgage is going to be. So the purpose of both of these is not only to affect the long-term rate that we're directly focused on, but to affect long-term rates more generally. So the other part of that, I've mentioned this, was the open-ended part of it, which was we're going to continue to do this until we start seeing an economic impact. Very different than what other central banks have tried to do, very different than what we've done. So if we get bad outcomes in the world, it means we may have a very big balance sheet. And Kathy's chart will get much, much bigger. If we start getting a lot of good outcomes, that's Europe solves its problem by Christmas and we magically solve our fiscal problem, then we may not have to do this very long at all. But part of it is taking the risk, or trying to take some of the risk out. It's saying we're not going to stay on the sidelines if bad outcomes occur. So frequently when I face a skeptical audience, people ask, well, you've tried this twice, it failed, so why are you trying it a third time? And my response to that is that monetary policy by itself can't solve all the problems. That if other things occur that are negative shocks, they may overwhelm what we're trying to do. We're one policy, but there are plenty of other things happening. Europe has had a series of bad events that are fairly uncharacteristic. We've had a number of bad shocks. We had a tsunami in Japan that really affected supply chains worldwide. We've had a number of shocks emanating from Europe. So each time we do this policy, we're hoping we don't get a whole series more of negative shocks. The fact that we got a group of negative shocks doesn't mean the policy didn't work. It does mean that the policy got overwhelmed by some of the negative things that were occurring in the economy overall. So if we don't get those kind of negative shocks, including self-inflicted negative shocks at the end of this year through the fiscal cliff, there's a good likelihood that it will make a material difference in what we're going to see. That isn't to say, though, that it's a panacea and that it will avoid and completely offset any kind of shock that we have. It mitigates the problem. It doesn't prevent the problem. It doesn't completely offset the problem. It makes the problem a little less bad. It does make the economy grow a little bit more than it otherwise would grow. So that is a very positive thing. It's something that we should do. But monetary policy can have limited effects in the current environment that we're in. The other element to what the committee announced was that we would keep rates very low until middle 2015. Now that's not an unconditional promise. That's kind of what we expect to occur if our forecast of the economy goes as we expect. It would be wonderful news to be able to tighten earlier, because that would mean the economy grew faster, the unemployment rate came down faster, and as a result, we didn't have to wait till mid-2015. But the other element of that, in that statement, was that we would keep these rates very low, even beyond the normal place when the economic recovery is starting to strengthen. So we're not going to pull back immediately. We're going to make sure that there's a self-sustaining recovery before we start tightening. Now, I didn't emphasize enough in the Japan chart, but in 1997, they thought their economy was picking up. They slammed on the brakes with fiscal policy and monetary policy and had a very significant problem after that. What this is in effect doing is promising that we're not going to repeat the mistake that the Japanese had. That we are going to wait until we really see some strong evidence that the economy is picking up before we're going to start taking tightening actions. So what are the ways that we would expect this kind of action to take? There are a variety of ways, and these things are really hard to measure, so nothing's done with any level of precision. But this is to give you a ballpark figure, because this is kind of a new policy, that's the best we can do. And so if you're somebody in the business school, you probably see a lot of event studies, and basically it looks like, what is the impact if you announce an event and it's a surprise? How do the financial markets respond? So this is in effect trying to do a little bit of that. So I picked 4 different periods. The first is when we announced the Federal Open Market Committee statement, is when we make the official announcement. So I'm looking at what happened around that date. But we now have these 2-day meetings where the chairman actually talks after the meeting. He actually talks for a pretty long time, and it gets pretty close to the end of the day. So I decided to include the next day in there just because you may not have fully understood everything he said. It takes a little while to process, even for economists. So I used a 2-day event window in case it took a little while for financial markets to figure out what was being said. But it's also that many people actually anticipated that we were going to take some kind of action. So at the previous meeting, we had announced if there's not a sustainable improvement in the labor markets, we're going to take some action. We didn't say what that action was. We didn't say what the size of that action would be. But it was kind of anticipated that as we weren't seeing any improvement in the labor market, that we probably were going to do something. And as it got closer to the date, people assumed it might be bigger rather than smaller. There's also a meeting that the Federal Reserve has at Jackson Hole where the chairman normally gives a speech. And in that speech, he highlighted the fact that he thought, while there are costs to additional asset purchases, and while the benefits were uncertain, that he thought the costs were relatively small, and the benefits, while not as large as he would like, were large enough that it may make sense to do it. So you might have assumed that after the Jackson Hole speech, again, they might not have known exactly what we were going to do, but they had some sense that something was going to happen, so maybe you want to look at how much of a reaction there was from that period. So it's just different ways of trying to measure, was there any impact? So what are the ways that you would expect an asset purchase program to make a difference? Well, if we're buying securities, particularly low-risk securities, if somebody's holding a long-term Treasury security now has to buy something else. That something else might be a corporate bond, might be a high-yield bond, or it might be putting their money into the stock market. The last couple times that we've done big asset purchase programs, the stock market's gone up. We generally do expect that the stock market will go up. Why do we care about the stock market? Because people tend to consume a little bit more if they feel a little bit wealthier. If your 401k goes up, if your other stock prices go up, people consume out of that. So one way that you might expect monetary policy to work is if stock prices go up with the action that you're taking, people are a little bit wealthier. When people consume more, we're employing more people. And what you see is that regardless of the window that you pick, there has been a reaction in the stock market. Now, that's not to say that we couldn't have a shock in Europe that overwhelms this kind of effect, but the kinds of effects and the kinds of magnitudes we're talking about are roughly what you might have expected. Second is the exchange rate. The Federal Reserve doesn't focus on the exchange rate. We're focused on our own domestic policies. But if we lower rates and nobody else does anything, you're not going to want to invest in the United States as much as you otherwise would. That's true for conventional policy. That's true for unconventional policy. Shifts in interest rates do cause people to move their assets to other currencies. Now, why would we care about transmission through the exchange rate? Because if you're an exporting firm, it really matters, because you care about the fact that the exchange rate's moving. So if you depreciate the dollar, you're going to be exporting more goods. If you're a manufacturer in New England, that means you have to hire people to produce those goods. So a second way that you might expect it to occur is through the exchange rate. And a negative number here means that the dollar depreciates. Now, we're not looking to have it depreciate a lot. In fact, our focus is not on the exchange rate, but it is one of the ways that monetary policy is transmitted. Once again, you can pick which event window you think is most appropriate, but the signs are all fairly consistent. The magnitudes vary. Third is that we're trying to affect other long-term yields, investment bonds, high-yield bonds. Again, what we're trying to do is flatten the yield curve, but to anybody who wants to borrow. So we would hope that we would see the investment-grade bonds, the yields, to drop, and regardless of which window we pick, we get that effect as well. Finally, the most direct effect is on the mortgage market. We would anticipate that there would be an impact on the mortgage market, and actually that effect was much more substantial than you might have thought. In part because I think most people thought we were going to focus on the Treasury market, not on the mortgage market. So around the previous FOMC and the chairman's speech, there wasn't as much focus on the mortgage market, but once we made our announcement, that really was a surprise. So it really wasn't a surprise that we did something. It was a bit of a surprise that we were so aggressive in the mortgage market. The wholesale rates have come down very substantially. We're seeing some movement in the retail rates. I would expect over time that those retail rates would continue to go down. So we don't directly control how well that transmits through the banking system. But around the previous periods, when those wholesale rates have gone down, as banks have been able to process all the paper for people that are doing their refinancing and new home buying, you start to see the rates go down as the back office becomes a little unclogged. And I would expect the same thing to happen here. So in conclusion, the action is really intended to promote much faster growth and return the economy to full employment more quickly. I'd highlight that monetary policy by itself is not a panacea, and that we could still face large shocks, and we can easily imagine large shocks. They could come from China, they could come from Europe, they could come from a dysfunctional debate in Washington at the end of this year. But the goal is to get the recovery to occur more quickly than it otherwise would. To get labor markets to improve more quickly than they otherwise would. We want to get back as quickly as we can to that dotted line that I showed you. So that is the purpose of the policy, and the purpose is basically to make sure that this period doesn't become great in the economic context. So thank you very much.